92.5% of founders who raise some money will not see anything out of their company equity. Any money in liquidation of a company will go to the preference shareholders first. That's not what he's in the game for. He's in the game to have that $1 million turn into a 10x or more. Had this bug of wanting to do something by myself. When I was a kid, I would set up businesses, do stuff, bought 10 companies, I've sold one company for $50 million. I've sort of been in that space for a very long time. I was trained with Deloitte and worked in practice for years, being the CFO for over 15 years. Outside, if I had to pick anywhere in the world to start this business, I probably would pick Silicon Valley as probably it's the best place to start this business in the world.
What did you learn back then that helped you when it came to... Welcome to another episode of Talk with the Scot. I am here with the founder of Aption.com, Alon. Thank you for taking the time out of your busy schedule to talk to me.
Thank you, Paul. Thanks for having me.
I've thought a lot about what we're going to talk about, and we could go in many different directions because you've been around the block a few times, Seeking Alpha, Natural Intelligence, a lot of big companies. But I really want to focus on Aption and your journey, how it came about, because a lot of people out there will be sitting, and especially in this country, sitting and thinking, you know what, I want to go down the path of opening my own business, and maybe have a lot of fears, challenges, just having no clue where to start. So if we go back to the beginning, why, where, what?
Sure. So Aption and specifically sort of the launch of Aption when I launched it was a combination of a few things. Maybe the backdrop to that is I've always had a entrepreneurial streak. And that never really sort of was allowed to flourish in my career in terms of I've been in probably the roles that you would least associate with entrepreneurship, which is the finance roles, often CFO roles. But I've always had this bug of wanting to do something by myself. When I was a kid, I would set up businesses and do stuff, and then life got serious and marriage, mortgage, kids, and one thing that entrepreneurship is tightly associated with is a lot of financial uncertainty. So a lot of added responsibility to my family, and I never took that plunge. The idea for Aption actually came around from being in those finance roles for so long. So I've worked in a whole bunch of venture-backed tech companies. I've written, must be thousands of options to employees. I've worked with and advised a dozen or more founders over time. And generally, I've been in good companies that have had a lot of success and grown a lot, and worked with founders who've had from moderate success to immense success. And
You're a qualified accountant.
I'm a qualified accountant.
You understand that whole the whole finance business world pretty well.
Yeah. I was trained with Deloitte, worked in practice for years, being the CFO for over 15 years, been involved in raises in aggregate about $200 million across 6 raises. I've bought 10 companies. I've sold one company for $50 million. I've sort of been in that space for a very long time.
Yeah.
And over those 15 years, I've written options to, must be thousands of employees and tens of executives. And some of them have sat on fairly hefty chunks of fairly valuable company. I've worked in 2 companies that have, at least at a point in their cycle, been worth over $1 billion.
Question. Thinking about that. So, you mean, I know a lot of people, obviously, who have worked in companies where they've gone public, they have options, and it can be life-changing money. When you go through that process and you see the potential impact on other people's lives, what gratification, how does it make you feel?
So as a cold numbers guy, until that gratification is until that potential is realized,
Yeah.
it's just that, right? And the number of people who actually manage to realize that, in my experience, has been very few. And since I started this business, just through speaking to people, the number of stories there are of people who were involved in like what looks like from the outside really successful exits and ended up with peanuts themselves, even though they were sitting on like serious percentage of the company. Is mind-boggling. And so, I mean, there's a lot of statistics.
Is that because they held on to the options too long? Is that because the VCs, there was some underhand, dirty... For anybody watching this, you will see a different background. We had to move halfway through because Alon didn't book the room properly. But anyway, we will carry on the conversation. We're talking about people that... Founders, exits with options, and they end up with very little. And is that because of dirty games or?
So normally not dirty games. It's just for a whole bunch of financial engineering reasons. So firstly, any money in liquidation of a company will go to the preference shareholders first. If the exit doesn't return the pref stack, then there's no money for the ordinary shareholders, which is founders and employees. Typically, that's sort of at one exit, it's more or less the money that went in, but often there are enough situations where there's some sort of enhanced preference. It's a 2x, a 3x, or there's a coupon. So like one of the sort of more common names that has one of these features is Redis that has an 8% coupon. So every year, every preference shareholder gets another 8% that they get back first. So that could be one reason. It could be that the company IPOs. There were a lot of examples like this in 2021. After an IPO, there's a lockup period where most shareholders can't sell, certainly not the employees, for typically it's 6 months.
Okay.
In 2021, generally what happens more often than not in that 6-month period, it's called the post-market period, the stock falls. That can fall to below your option strike price. In 2021, it happened even more than normal because the market fell in sort of the later half and earlier half of 2022. And so that could be another reason. Then there could be other reasons in terms of M&A where options are sort of rolled over, or the transaction structured in such a way that you don't necessarily see much, or at that point it can be deferred. So there are a whole bunch of reasons that usually aren't dirty games.
So before we get into what Aption is and your personal journey through establishing Aption, what practical tips or things could you give any founder or anybody that is thinking about raising money? What should they be looking out for?
It's a big
question.
That's a big question.
Yeah.
So I make a bombastic statement that we could spend the rest of the time unpacking.
Absolutely.
But the way that transaction documents have been structured for all sorts of historical reasons are extremely founder unfriendly. So if you take the typical transaction documents in the US, they're called the NVCA templates. They have a lot of clauses that give the investors a asymmetric and disproportionate amount of influence and control on the companies. Typically, these come about through vetoes. So there's a whole raft of actions that a company may want to take, and ultimately that comes down to whether the investor will approve it or not. Even if it's your first investor, he has 10% or 20% of the cap table. Your two co-founders, he's one seat on the board. And so theoretically, you should be able to do a whole bunch of things. Most material things that you want to do as a company, the investor, the preference shareholder, is going to have a veto on. You're going to need their support, from approving annual budgets, typically through to fundraising, to subsequent fundraising, to M&A events. So there are a lot of situations where that can make sense, but there are a lot of situations where de facto your investor has a stranglehold on the company. and your interests are not always aligned. In fact, the most fundamental interests of a VC investor in a company and a founder are misaligned from day one. So if you set up a company and you raise, say, $1 million just to get started, and then after a year, someone comes and says, hey, I will pay you $30 million for this company, and you raise that $1 million I'll create probably a more likely scenario with more tension in it. Someone comes and says, I'll offer you $10 million for the company, and you raise $1 million at a post of 6. Then you, the founders, still after ESOP, you probably own 80% of the company. The investor's just not interested in that. It's got no interest in investing $1 million and getting a 6-7% return after a year. That's not what he's in the game for. He's in the game to have that $1 million turn into a 10x or more. You as founders, you've been doing this for a year. Someone comes and says, "Hey, take $8 million." That's a really big deal. And even assuming you had employees that have vested, and early employees typically would get that's a nice payout. It's not like life-changing money for employees, but you've been doing it for years.
Yeah, for sure.
And so you have misalignment on something like that. And there are many, many examples where there's economic misalignment, and the transaction documents are written in favor of the investor. It's that simple. And so the starting place for most of these transactions is not a founder-friendly starting place. And I'll give a very, very common example. So for obvious reasons, in terms of oversight and governance, if a founder wants to change their salary, they need board approval. And typically your investors, the preferred shareholders, will have a veto on that. So if you go end of year and say, listen, I've been doing this for 3-4 years, I've been stuck on the same salary that I've been on for a while. I'm not asking for much. I just want something to, an inflation rate step up to 5%, 10%, whatever, right? Increase after X years. Your investor should say no without any reason. And that
nothing that the founder can do.
Nothing the founder can do. And that can turn something which should be a no-brainer and just a simple ask into politics, right? Because it can come when maybe the company is not doing great, and still, in terms of you and your family, you need to, your equity doesn't feed your family. They can't pay the electricity bill. Your investors are taking their management fee. Doesn't matter if their portfolio is up or down. They're taking their management fee, irrespective, and they're drawing their salaries. And it can turn that discussion into political and complex discussion. And often founders will say it's just not worth it. It's like to have this fight over. And that's how that's the standard default transaction document. So there are many, many of these clauses that I would advise founders to look at. Now, there's a flip side that you get into negotiation into what are considered industry standard clauses. It's going to prolong your transaction. It's going to increase legal costs.
But at the same time, it makes sense to have yourself a good lawyer, but working through that process.
Yeah, but it's even worse than this, because this is so sort of industry standard that most lawyers won't even flag these clauses for you. No lawyer will come and say, hey, you should have, I don't know, no lawyer, but I doubt many lawyers will come and say, you should ask for a carve out on the founder's salary that the veto only applies if it's over a certain percentage increase.
So do you think it makes sense as a potential founder, prove the concept, maybe even self-finance if they can for X amount of time, and only once they've got more cards in their own hand, then go and seek the seed or round A, whatever it might be?
Yeah, that's all. I mean, that's always true. You always want to go and raise with a strong hand, be it traction or whatever it is. I think that's always good advice.
The reason I say that, I think maybe not so much in Israel, but obviously Israel being the startup nation, there's loads of companies. I mean, you hear of companies being set up all the time. the same time, you're hearing of companies always sort of going to the wall. But I think there's this perception that you set up a company, you raise money, you're going to make money. And it's obviously not as clear as that.
I mean, the statistics are horrible, right?
Yeah.
So it's 92.5% of founders who raise some money will not see anything out of their company equity. Yeah, a lot of that is just execution risk and failure, but a lot of it is also VCs will push you, rightly from their perspective, to raise more money because capital can drive growth and they're in it for the big wins, right?
Yeah.
And that's their business model. It's fine, right?
Yeah.
And in many cases, it's a very suitable business model for a company. If you've got a massive idea which requires a lot of capital to get off the ground and hit the jackpot, like it 100% makes sense. And as you raise, you just raise the hurdle for what exit you need to return money. So yeah, it ends up that slightly over 90% of founders that manage to raise something in the first place will never see money from their company.
It's a crazy statistic. It really is. And I speak with a lot of founders on a daily, weekly basis, and they are chasing the dream. They passionately believe in what they're doing, but as soon as they raise that first round of money, like VC funded round, it completely flips, and you see the demands change, the expectations change, and it's no longer their little baby where they're having fun along the way. It's now reports and numbers and growth and churn rates and all of those things.
Yeah, so I actually think a lot of that is healthy. I think what investors and VCs are very good at doing is they know how to look at a business and they know often they know what's important. And certainly when it gets down to just metrics, they know which metrics you should be monitoring or which ones are important to move and when and how. And that's healthy discipline. And it's very hard to do when you don't have that board there and those investors there. And so I think that actually creates a lot of like healthy dynamics. And it's, life is probably more fun when you don't have to, report to anyone and there's no accountability. But on the flip side, it's probably less impactful.
Yeah, maybe you used to work for one particular company that scaled massively, and I don't think raised money in natural intelligence.
Yeah.
I think it was self.
Natural intelligence, it was and is a bootstrap. Yeah.
And he scaled it to an incredible size.
So yeah, firstly, Nir Greenberg is a phenomenal human being and a very good manager, and he's was always very metrics focused, and natural intelligence is a sort of business that you have to measure constantly to succeed in. So Nir's special, and he set up a very good team. He always had very, very good people around him, and progress was always very metrics driven. It's a very easy business to measure, but it's a lot of people don't have that discipline, and a lot of businesses are a lot more complex to measure.
Yeah, for natural intelligence, it's very clear cut if it's proving itself or it's not. What did you learn back then that helped you when it came to Aption?
So I think Nir was the first person that I worked for that saw a lot of the world through people. And he always knew that he needed very high quality people to be successful and the right people in the right seats to be successful. And that played out. And that focus on getting the right people in the right seats on the bus, that people focus and the not only getting high quality people, getting them in the right place in the company was something that I just saw the impact of and took that with me, not only to Aption, but to other places. And you find the right partners to do business with. And actually, when I set up Aption, spoke to Nir a lot. And when it came to sort of taking co-founders, that was his advice, make sure they're the right people with the right skill set, with the right dedication. And that's something that's, I've taken and I think has always paid dividends for me.
So I 100% agree with you, because you hear so many horror stories of founders, like 2, 3, however many that's set up, and it blows up quite quickly because they're not aligned. At the beginning they might be, but very, very quickly especially when, big decisions, financial decisions come into play, it's very, very easy for somebody to think, we'll go down this path or we'll go down that strategy, and it blows up. I definitely want to touch on that. So when you had the idea of Aption, I think there's 4 of you that set up the company. How are the people that you knew? What process did you go through to ensure that you were as aligned as much as possible?
So yeah, each of that team of 4 that you referred to sort of came on at different points in slightly different constellations. The first person that came on was Aaron Rosenson, who came on really, really early. Aaron is a VC. He was a partner at Aleph. He was at Inside Partners before that. He was on my board at Bring, so I've known him for a few years. I went to consult with him when I was thinking about this idea and set it up, and I wanted the VC perspective. And through those conversations, sort of one thing led to another, but in that process, we spent a lot of time making sure we are aligned, and we actually have a document somewhere where we literally listed out in a grid, here are different things that are important to us and what's our different approach and can we get aligned on.
Things such as what?
From financial things in terms of how we see financing the company, through to what was important to us in terms of our families and work-life balance, and sort of personal financial constraints, through to how we would take operational decisions and how we think about operational decisions and management decisions. And so literally we mapped really big areas and made sure that we were on the same page in terms of how we would broach certain challenges.
So let's touch on a couple of them, because I think they're very important and very applicable. Me and you have known each other for many, many years. I know you're married, kids, you've got a lot of things going on outside of your professional life. So the work-life balance, as a founder, the line, it's not an easy balancing act to make. How do you do that?
I think that's a very individual question. So in terms of, I think different people deal with that in different ways. I'm someone who's sort of very fluid in terms of crossing from doing something for work or doing something with my family, and I'm happy to do family things at sort of all times of the day, and also happy to work at all times of the day. So I've done calls gone midnight, or we have an investor in Australia, so sometimes to connect with the right person, you're doing calls at 5 o'clock in the morning, someone on the West Coast at 5 o'clock in the morning or at midnight, or personally, that doesn't bother me so much. And when we're on vacation, when I need, I'll try and find the way that sort of balances. I generally get up before my family and we can knock out a few hours before they're even up. And so I think it very much depends on what as a person you need, because if you literally need to switch off totally from work to clear your mind out, then you need one type of way of doing it. If you don't need that, you can jump between things, and then you'll have a different balance, a different juggling act.
Yeah, no, I think you said something there that very much resonated with me, because when I had my agency, we used to obviously go wherever on holiday. I used to wake up a couple of hours before the rest of the family, deal with whatever. Then we would go out for the day. I wouldn't necessarily be 100% switched off. I don't think when you're a business owner, founder, whatever, you're never totally switched off. But I would go out for the rest of the day and then come back, and the last couple of hours of the day I would sit and do what I had to do, catch up, deal with anything planned, stuff for the following day.
Yeah, technology then, our phones make life on the one hand very easy, and on the other hand very hard, because you need to know when to leave something, but then you can just respond to something from anywhere.
Yeah, absolutely. So let's go back. So there's 4 of you and I think you said Avi.
Yeah, Avi runs sort of our whole customer ecosystem and go-to-market, and Lev, who runs all of our technology.
Okay, so what is Aption?
Aption allows founders or employees, anyone who an equity holder, to take part of their equity position and switch it for a portfolio. So I like to say it allows you to take a roulette chip and switch it for a VC style portfolio.
So when you focus, are you focusing on one particular industry, or you're interested in just helping and making money?
I mean, in theory, the concept that people end up over concentrated in assets and that diversification is a good thing for them is applicable across a huge number of use cases. Like one really common one that we deal with actively is you go and work for a venture-backed company, you end up with options, the company has moderate success, or you founded a venture-backed company, the company has moderate success, suddenly on paper you have $500,000, $10 million, $100 million, whatever it is, in this one venture-backed company, which by definition is part of the riskiest asset class on the face of the planet and the most illiquid asset class on the face of the planet. And that represents anywhere from 50% to 98% of your net worth.
Okay.
But that's true of someone that went and bought like a rental property as an investment. So suddenly a large proportion of net wealth is in one property, in one city, in one road. And so the principle applies across a huge number of asset classes. We're very focused on venture-backed companies right now, but in theory, we would do this for a hairdresser who's got like their one business, all of their wealth in one business, or people that have bought real estate assets, or partners at a law firm that have profit share from one law firm. If that law firm has a really bad there's a scandal about how they rep whatever and they lose clients, like their lifelong profit share has been cut because they're exposed to one asset. So theoretically, you can do this across a whole bunch of stuff. Okay. Right now, we're focused on venture-backed companies.
Would you think I guess, we're sitting in Israel, and as I said before, startup nation. Do you think this is a place to be, really, for a company like yours? Does it open the doors to so many more opportunities?
It's not a bad place to be. Outside, if I had to like pick anywhere in the world to start this business, I probably would pick like Silicon Valley as like probably it's the best place to start this business in the world. But like after Silicon Valley, this is likely to be in your top 3 or 4 places. Maybe New York slightly better, but Israel has a very active startup and VC ecosystem, and so there are lots of companies. The tax regime here and the regulatory environment make it relatively easy to do business compared to America. It was definitely a good place to start and test out the ideas and see how we got initial traction. Today we've done into the hundreds of deals, and so that's just been a learning curve, and psychological aspects of it, and how you structure a product we can take to any place in the world. Obviously, the tax aspects we need to build jurisdiction by jurisdiction.
Okay, obviously there's 4 of you. It's a lean company in terms of personnel, but let's say tomorrow you decide that you need additional support, additional help. What would you look for in people? What are the sort of your minimum requirements?
I think there are probably 3 things that I generally look at. One is domain expertise for whatever they're doing, assuming this is a job that requires domain expertise. Like if you're looking for don't want to name specific roles because I don't want to knock any given like profession, but obviously there's some more sort of entry level type roles. You may need less, but you need aptitude / knowledge and experience in the particular domain. So you need to have the skill sets that fit to the domain. Second, I think especially in early stage company, I think just work ethic is really, really important. And if you don't have someone who will knock out work, and that doesn't necessarily mean like put in tons of hours, but when they're on, they're effective. They're getting stuff done. I think it's super important because execution beats strategy almost every day of the week. If you've got an amazing strategy and you're not executing against it, you're not going to get anywhere. And thirdly, it's just an interpersonal relationship. Like there's all sorts of variations of that rule of like no jerks policy or whatever have you. But you you've got to enjoy working with them. You've got to get up every day.
Well, people buy people at the end of the day.
People buy people at the end of the day.
Yeah. And if you don't have that connection, whatever it might be, interest, then I think it's a huge driver. Because I often think about what are my like non-negotiables. If I'm building a team or I'm even just recruiting a person, what are my non-negotiables? And not so much about their talents, more about what are my non-negotiables in terms of just the person, the character that they are. I'm not sure everybody does that. They always go for like the experience and forget what pitfalls another person can bring in.
I think generally my first sort of litmus test is just, would I have fun with this guy? Will I get up in the morning?
Did you go for a drink with the person?
I go for a drink? And would I want to go for a drink with this person, like, day after day? And if I can't answer that, like with a yes, with a fair amount of conviction, then it's going to be annoying, right? It's going to be frustrating for me. It's going to be frustrating for them. So that's almost the first checkbox. But yeah, absolutely. Sort of experience and expertise is after that. So it's high up on this as well.
Okay. I work with a lot of tech companies, cyber security related companies, AI companies. And we're getting off topic a little bit, but I just think it's such a buzz industry, obviously at the moment, AI. What impact will AI have on like the VC world? Or maybe it's already started to?
It's a really good question. The bottom line answer is I don't know. I think it's really, really hard for any of us to actually envisage this. I was recently speaking to one of our relatives who's like very senior in the pensions industry, and like as we were speaking, I said, you know what? I'm not sure pensions are going to exist in 50 years' time. He goes, what do you mean? I go, look, if you take AI to the logical conclusion, most of us don't need to work. And then how are you even going to accumulate a pension because you haven't got a salary? The way you'll live will be something else, which I don't know what that looks like either. I don't know who pays how you redistribute wealth. But I think AI has the power to redefine so many elements of life as we know it. I don't know how entrepreneurialism looks in 50 years' time. So I don't know how VC is going to look there. I think the only thing I can say with a relative amount of conviction is that people are going to have more leisure time. And so if you're investing for a long-term horizon, it's probably a good bet to invest in leisure companies, cruise companies, hotels, Disney. Aside from that, I don't really know.
Yeah, no. I had a meeting before I came to see you, and it was all about AI and the impact on the digital space. And that might be a little bit easier to figure out or just see where the direction it's going in. But still, I think it's just moving at such a fast pace.
Even that, like the interfaces that we think of, I'm not convinced are going to exist in 10 years' time. I'm not convinced if you interact with a keyboard and a screen, will everything just be voice interactions, or at some point is sort of Neuralink or Neuralink-esque technology going to take? And I'm not sure those communications and interfaces continue as we know them. So I don't know where it ends up.
Oh yeah, and the concept of apps probably won't be needed if AI advances in the direction that it could go.
Yeah, totally.
So it's going to be interesting to watch it. It's probably a problem for. Well, I'm getting on, but it was probably
our kids or grandkids.
Yeah. So I can leave it. Okay, so back to Aption. 4 of you keeping it lean, very tight and focused. When you're looking to work with somebody though, what are you looking for? I'm talking about on a business level.
You're talking about like a joint venture we would do, or a supplier, or what sort of?
Both. I mean, they're not going to be the same. So
yeah, it's true. So I mean, first and foremost, it comes back to similar rules as employees. Like you want to know that you're going to be able to get on with these people, and you're going to want to know that when something misaligns and you have a disagreement about something, you're going to be able to sit down and work it out without the whole thing exploding. You want to do business with people who are ethical, who have similar moral compass to you, and that you're more or less on the same page with. I'm going to want to know that I fit into their business model, or I'm a significant enough bet that they're going to give me the time necessary to adjust whatever they need to do. Those sort of motivations are aligned so that wherever we end up, we have enough alignment that's going to be mutually beneficial. At the end of the day, it's got to be good for us, it's got to be good for them, and you've got to think about their side also. Because you don't want to, even if you have the upper hand in the negotiation, you don't want to abuse the power dynamic in a way that it's not going to be a good deal for them, because years time, 2 years time, 3 years time, whatever, things change, and then
so you believe in the win-win
scenario.
And I'm saying that
only the win-win scenario,
right? And I'm saying that because I was smiling when you were talking just there, because this is it's a harsh environment, business environment in Israel, and sometimes people go into a deal and winning for them is about the other side losing. And I agree. I think that to some extent that's a short-sighted outlook on things.
Yeah, I don't know if it's any, like, my biggest sort of business challenges have actually always been with people outside Israel.
Yeah.
You always have sort of shocks in every country, in every ecosystem. I'm not sure Israel has an outsized number. Maybe it does. I don't know, but I think businesses always relatively ruthless. Like, people are out to do deals and make profit, and that's okay. That's
for sure.
That's how capitalism is built.
Yeah.
And yeah, 100%. I think if a deal's not win-win, everyone at the end, it's likely that everyone loses.
I had a very funny meeting about 6 months ago. We got halfway through the meeting, and the person that I was talking to was very blasé about KPIs. KPI this, KPI that, and at some point it just clicked with me. I don't know what a KPI is. So I managed to, like, we figured that out, and we dealt with it. But let's talk about KPIs, the importance of them, and providing you know what a KPI is, and how you go about setting those KPIs.
So it starts with the sentence, you can't manage what you can't measure. So if you're trying to achieve anything, if you can't measure it, you're not going to know if you're succeeding or not. That's where the concept of KPI starts. And generally, when we set ourselves a objective to do something, the next question is, okay, well, how are we going to know if we've succeeded? And that, by and large, is a KPI. So the way that I tend to work is we pick generally 3 objectives, a maximum of 3 objectives. We define for ourselves what success looks like. We then would define sort of the more nuanced parts of that. You may not always see that lagging KPI come through. Let's say you're talking about sales. Sales is something that's pretty easy to measure, and so you want X million dollars of business done in this time period. So that X million dollars of business is going to go through a pipeline. It's going to be an opportunity before that. It's going to be a lead before that. And before that, it's going to be activity. It's going to be calls. And so you're going to want to trace back, well, what are the activities and the leading indicators that are going to tell me that I'm on the right track for that? And how do those map back?
Every step of the funnel, basically.
Yeah, of the funnel, or the funnel if it's sales, or journey if it's something else, or you really want to map that and understand sort of what are the different things. And then at different points, you're going to have different emphasis on different KPIs. So you might start with just like, well, am I doing enough calls? Which is just an operational KPI, and those calls may be high quality, it might be garbage. But you're also going to look at okay, how many leads do I create, or how many opportunities do I create? Or if you've got a more complex business, you're going to put all sorts of different levels of qualification in the journey. And so sort of that's, if we say talking about sales, I mean, sales is like, it's just the easiest to talk about. So it's maybe a cop out as an answer, but you can measure how many qualified leads do you have, and how much qualified pipeline do you have in terms of dollars, and then you can add another level of qualification there, call it an opportunity, or call it whatever, and how much of that do we have, and how much of those opportunities do we qualify as most likely because they've already given certain indications and they've already had a look at our legals and stayed around or whatever have you. So it's really about what are we trying to achieve from a commercial perspective, business perspective, how are we going to measure those things, and then what are all the different important indicators that feed into that are going to let us know if we're tracking.
I think it's probably also vitally important. You have long-term KPIs, short-term KPIs, and you need to constantly be assessing and analyzing. As you know, I'm digital marketing 20 plus years, so it's very, very straightforward to look at the numbers, although Google makes it much harder these days, but look at the numbers and, are you progressing? Are you seeing the numbers? But one of the most commonly asked questions that I get when I'm speaking with founders, even before we start working together, is, okay, how much additional traffic am I going to see? Or how many more leads am I going to see? And that's very difficult to answer, certainly before you start. You have to be creative, but in an honest way, obviously. Creative in setting clear KPIs and things that are quantifiable.
Yeah, and you touched on a good point. It has to be realistic. You need conviction that you can actually achieve this. Because saying, hey, I'm going to 10x my revenue next year or whatever, but you actually have no idea, you just don't have the staff, whatever, right? There's just no way you can do that. It's not going to help you.
Yeah.
So working out, sort of putting in place a tangible plan of which activities are going to lead to that and what resources you need to do that. That's just part of the planning.
Yeah. The world economy, and I know we're going really big at the moment, the world economy is probably not in the best place it's ever been. I see it from my side of the table. It is tough going in terms of budgets and companies that are downsizing in terms of personnel, looking at marketing spend, definitely looking to reduce marketing spend, but needing to increase their bottom line. What challenges are you seeing? What are founders talking to you about? Challenges that VCs are seeing at the moment?
I think global economy is a very interesting place. There are a couple of major vectors that put us at a very unique place in history. AI is, I think, a big one. I think we're already seeing that creep into results. I think people are realizing, wait, I can be more efficient.
Yeah.
I can do this with less. There's an earnest attempt of reducing the US budgetary deficit, which has been a huge overhang on the global economy. So that's also massive.
Yeah.
In terms of business, there is more of a focus on profitability. The markets go through these mood swings, so they'll be focused on growth, and then they'll move back to no, I actually have to make a profit. There is some tie into interest rates. When interest rates are very low, then growth is much more important than profit, and that's just how the discounted cash flow comes out. And that market focus on growth obviously feeds down into the venture world, and people are trying to be more efficient, and it feeds down into things like CAC metrics and user acquisition metrics, and that slowly feeds down into marketing budgets as well. I actually think it's healthy. I think the world back in 2021, when 2020 growth was on steroids, at the end of the day, companies are valuable because they can make money and they can return value to their shareholders. And so if you don't know how to turn a profit, then you don't have a long-term right to exist as a company. And we sort of forgot that, and we will forget it again. We'll go through another cycle where growth will be valued way above profit, and people will swing and lean into that and make changes. I'm actually the school of thought that you should always understand your unit economics. You should always be on top of your unit economics. You should always make sure that you know how you can make a profit if you choose to make profit, and it may be advisable at a certain point in time grow rather than make profit, but you shouldn't do that at the expense of your core unit economics. And managing that is tricky. But I'm actually sort of at a macro level. I think we're in a interesting time. I'm a little bit more bullish on. I think a lot of markets are overvalued, but in terms of like core business fundamentals, I'm quite bullish on companies being successful in the short term.
Short term, okay.
Maybe the long term, but that's a really long.
Sticking with that.
It's a really long time period.
No, I think things are moving so quickly.
Yeah.
That at the moment, it's probably a safer bet just to think short to medium term as opposed to, that longer term. And short to medium term, maybe the next 2 quarters even. I had a meeting this morning with somebody, and we were talking Q2, Q3, and then we started to touch on Q4, and he said, "Hold on a minute. We need to get through. Let's look at Q2 and Q3, and based on that, we can talk about Q4."
Yeah,
it's interesting times. At the very beginning, you said you're a very numbers focused guy, and I know that about you. How does that impact your decision making process?
There's a pro and a con. So the pro is like generally things manifest themselves in numbers, and so if you're very deep in the data and you're very honest about what the data says, you're more likely to make decisions that are rational. Well, let's say rational and calculated. The con is that, especially in early stage, often you have to work without data. You just don't have enough, right? You haven't done enough deals. You haven't, whatever it is, right? And then you tend to make certain assumptions, and those assumptions tend to be more conservative than when something doesn't work, then it's more or less binary. So it's like, it's either a 0 or close to 0. When something does work, your conservative assumption is likely to underestimate how impactful it is. And so like I can think of a couple of examples of either. So we went and did some PR, like whenever it was a few quarters ago, and it cost us whatever it cost us, and it was like a complete flop, and got us nothing. It got us like some articles in positions that that just didn't move the needle at all. We did some other PR which actually cost us nothing, which was great, but whatever. And then there are sort of other things that we've done that we have done very cheaply, mainly because they just didn't we could build it fairly cheaply, and it put in place sort of marketing motions that have been very generous in terms of lead generation.
Okay.
And if we made sort of assumptions on either of them at the beginning, we probably wouldn't have got it right. And so what that tends to mean is that I'm overly sort of conservative on my assumptions, and then I'm more reticent to take a bet on certain things that probably I should be taking a bet on. And some parts of them, some of them won't play out, some of them will. But yeah, I think that's sort of like the pros and cons of being numbers driven.
Numbers driven, fair enough. You think you need to be a certain character to be a founder?
You need a lot of self-belief, and you need a lot of belief in the dream. You think you've seen. I think most founders think they've seen something that almost by definition doesn't really exist yet. In many businesses, some it does, but and you've got to believe that people are gonna actually want this, and there is a pain here, and there is you have a solution, and other people are going to come along for the ride, and you're not always sure, right? It took us time until we got our first customers, and it took us time until we raised our first money, and you don't always know if someone is going to come along and go, yeah, I see that. And
I think that's a huge challenge, because you might have the idea in your head and think, that's nobody else is doing that. This is amazing. If people don't understand the concept, very, very quickly, especially in today's world, you're going to have a really tough time making a success of it.
Yeah, I mean that's salesmanship to an extent, but I think I'm quoting a very common saying that as a founder, you've got to be used to hearing no. whether you're fundraising or selling, but that's whatever you're selling, right? Most salesmen hear like 10, 20 no's for every yes they hear. And you've got to have that. The difference is when you're a salesman for an established company, like, people buy this product, you've sold hundreds of millions of dollars of it. When you're a founder, you've got to have that self-belief. You've got to have that sort of resilience of, and also you're going to get a ton of stuff wrong along the way, right? You're going to assume certain things. It's not going to play out like that. You're going to go back. You're going to redesign it. And so you've got to have that resilience of, I believe in the big picture. Not everyone's going to agree with me. It's not going to be the right fit for everyone, but there are going to be enough yeses along the way. And you've also got to have the humility of sort of recognizing when you just were wrong. And because if you don't, you're going to be flogging a dead horse, and you've got to go back and try again.
A lot of money.
Yeah, or losing a lot of money. Yeah.
No, I was at an event last night, and I was talking to somebody, and he changed jobs a year ago. He was working for a cybersecurity company, raised hundreds of millions, several hundred people in the company, and the owners blew the whole lot. Yeah,
it's very easy, and we were talking about VCs earlier. VCs they won't encourage you to blow the whole lot, but you're raising money to build something and try and go and sell it. And if you're wrong on the market or a core assumption, you will blow the whole lot.
Yeah, and probably pretty quickly as well.
Unless you have the humility to and sort of the strong beliefs weakly held of, yes, I believe in this, but like if I start to see evidence that like some part of this or all of it is wrong, then I need to be willing to reassess.
We're obviously sitting here on a Thursday afternoon. I get that your partners have left for the weekend, so I don't want to keep you too much longer. But the last question is a question that I'm asking everybody, because I just think it's a great learning curve for anybody that's watching this, thinking about getting into business, thinking about getting into a position of management or leadership, or striving to wherever they're striving to be, because it's not plain sailing at all. Me and you have talked over the years about some of the challenges we've faced and difficult conversations we might have had with other people and things like that. So failure is a bruise, not a tattoo. I love it. It's probably applicable in every area of one's life. Talk to me about a time in your life, professionally, not going to get into your personal life, where you've taken a hard knock, but you've analysed it, you've learned, and it's really made you stronger moving forward.
I think I'll talk about a repeat bruise. There have been several sort of times in my career where I wanted I had my eye on a certain sort of career path progression, maybe moving role, expanding my role, whatever it was each time, with its own specifics. And there were times when I got it, and there were a couple of times where I got sort of hard no's, at least on one occasion, which led me to leaving that company at the end. And when I analyzed what could I have done differently, not in that specific conversation, but that conversation was as a result of a number of years of working together, what could I have done differently along the way to end up in a different outcome? Often my answer has come to, I didn't hire early enough, and I didn't hire strong enough. And I'm doing it today as well, right? I have a tendency to run teams small and lean. There are also advantages of that. You're more efficient, or in theory, it's easier to be more efficient. There are obvious constraints on that also. And so I think for me, I identify what you need, what you don't have, either yourself or in your team, where your gaps are, and hire to fill those gaps, and do that early, right? Do it as soon as you realize you're missing a certain skill set, and this skill set is going to be essential for our success. Hire someone strong, hire someone that you can trust to just take this and own this, and that you can relinquish your control to, and if not, you're gonna pay because you're gonna have someone without the right skill set doing that, and the results are gonna be suboptimal.
Or you'll be doing it yourself.
Suboptimally, right? So yeah.
Thank you very much for your time. It's been great talking to you.
Thank you for.